Hi, my name is Darren Joseph, and welcome to Tax. We're a team that seeks to demystify the somewhat confusing world of international tax, cross-border compliance, international tax planning. Today, I want to talk about U.S. pre-immigration planning. Now, typically, most of our videos talk about U.S. exposed persons who are doing business outside of the US. And today we're going to do the opposite, which would be non-Americans who intend to move to the US and the steps that they would typically need to do, well, not need to do, but at least recommend that they would do as part of that pre-immigration process. I mean, it is not an easy process to move to another country. It can be quite stressful, it can be quite confusing. And we tend to get preoccupied with the immigration piece. And unfortunately, we tend to miss out on the tax piece, which we think is super important. Now, ironically, most of our most popular live streams, when we do these live streams, are actually for US pre-immigration planning. And that makes sense since we tend to deal with high income earners. And when you look at some of the charts that are published around the internet, I think there's Visual Capitalists, there's Henry Partners, and those attract the movements of high net worth individuals. It's crystal clear that when you look at the top 10 cities in the world where high net worth individuals are concentrated, they're disproportionately in the US. The US has always, and for the foreseeable future, we think, will always continue to attract those of higher income earners. It is the rule of law, it's business opportunities, fantastic capital markets, opportunities for kids or whatever. So where our typical client, what is our typical client look like? They move for work, they work with a multinational, they work with one of the big banks, and they get relocated from Hong Kong or Singapore, London to Wall Street, to New York, or one of the tech companies, and they get relocated to California. Often as well, where it's more self-initiated, someone who runs their own business. It tends to be an education play. It's all about the kids, right? And again, depending on how you look at it, when you look at the top tertiary education institutions in the world, they tend to be disproportionately located in the US. Arguably 7 or 8 of the top 10 are in the US. So if you want the best for your kids, the conversation necessarily needs to be about the US. So we work with families who want to move to the US with a view to getting the kids into high school or getting the kids in as a more advantageous position to apply to some of the elite universities in the US. Some people want to retire, the retirement communities in Southern California and Florida and Texas are some of the most comfortable and some of the most luxurious and safe in the world. And people are looking for that. So that's some of the reason. But I think that's number 3 by a distance, but number 1 and 2 definitely were definitely education for those who are entrepreneurial, for those who run their own business, and they could be anywhere and they have that choice and that possibility. So those are the reasons why. Now, how can we work with clients like that? Well, we do so in one of 2 ways. We have a Zoom consult where the client comes to us with a list of their assets and their revenue streams, and we talk them through what the US tax implications are. And if they like it, we leave what that is. And if they don't like it, we will look at exploring ways of mitigating, if not eliminating, the unpleasant tax burden. So that's one way. The second way is where we just do pure math. So someone comes to us and says, this is our tax return from India or Singapore or whatever. And we ask them some additional questions, and we prepare a mock US return so they can see if they were to move to the US right now with the existing structures that they have, this would be the tax impact. And again, it's quantifiable so they can prioritize, I really need to pay attention to this, and this, as opposed to some of the others. And we work with them in terms of potentially mitigating some of the tax consequences. Now, how do we do that? Then that could be quite a lengthy list, because no one size fits all. There's no one solution that you can just package and you can sell to everyone. It really depends on their unique circumstances, but typically it'd be one of 6 strategies we'll be looking at. The first will be PFIC mitigation. PFIC stands for Passive Foreign Investment Corporations, and This is a designation that arose in the 1980s under President Reagan. And what it is, it's defined in the Inland Revenue Code in the Section 1297 as any foreign corporation that has more than 75% of its gross income as passive, like interest, dividends, rental income, capital gains, whatever, or more than 50% of the assets are held for the production of passive income. And I'll tell you what the context is to make sense. So in the 1980s, U.S. domestic financial institutions are complaining. They're complaining that, hey, Americans are being heavily incentivized to invest in mutual fund type structures outside of the U.S. because they were tax advantaged. So as a result, it just swung the opposite way. They created a PFIC regime, which, to be honest, under certain circumstances, can be quite punitive. So it can, to some extent, penalize you depending on the situation, investing in mutual fund type structures outside of the U.S. And a lot of investment opportunities, investment structures get pulled into this PFIC regime, so it's worth paying attention to. Sometimes it can be certain pension structures, certain insurance policies, foreign REITs being real estate investment trusts, and REITs might get pulled in. So quite a broad range of investment structures can be pulled in. So you'd want to work quite closely with your U.S. advisors. And again, this is something that U.S. international advisors will be familiar with, not really domestic, because domestic guys don't really see this. So you're probably looking to work with a U.S. international advisor. If it is that you have investment structures that do fall into the PFIC regime, you can work with your advisor around either unraveling it or restructuring it in a way that's more tax efficient, to put it that way. That's number one. The second strategy that we use would be accelerating the realization of non-U.S. source income. So, for example, some people have stock option, accumulated earnings, deferred compensation plans, notes, installment sales. They potentially could be accelerated. Let's see. Or sometimes accounts receivable, depending on how they've structured the investments or whatever. So anyway, so the focus would be, especially those with built-in gains or assets or structures with built-in gains, to somehow take the win before you enter the U.S. That's the huge takeaway. Take all the wins before you enter the U.S. That's number two. The third one is around, the third strategy we use is around built-in basis or basis step up in basis, sorry. What do I mean by step up in basis? Obviously, the U.S. has capital gains tax. Huge surprise to some of our clients who may come from like the Gulf area, the Gulf CC countries, the Singapore, Hong Kong, Malaysia, where there may not be capital gains, all things being equal. So capital gains, huge surprise, huge shock. Now, capital gains being the delta, the difference between what you pay for the asset and what it's worth at the point of the sale that's been recognized. Okay, so the taxable event, so that delta, it's taxable. So, and it's not contrary to popular opinion, the basis or the cost is not what you lock in when you become a U.S. person. It's what you purchased it at originally. So what we do is work with clients and ways of creating, at least in your home country, non-taxable events, which would create a step up in basis because, you've had an investment for however long and there's some built-in gains. So you may want to revalue it at the higher amount so that if and when there's a taxable event post becoming a U.S. taxpayer, the deltas and the difference between the basis and the selling price will be smaller, and so the capital gains tax will be smaller. So that's one of the strategies we look at. That's number three. Number four will be around foreign tax credits. Some people come from really high tax jurisdictions: Australia, New Zealand, Indonesia, China, Europe, particularly Northern Europe. Frankly, jurisdictions that are higher tax than the U.S. So in that case, sometimes going to the U.S. is a sense of relief because the taxes are relatively lower. Foreign tax credits. So if it is that you have assets that are still in your country of origin in that higher tax country, you may want to, again, structure your affairs so that if and when there's a taxable event, the taxes that will be due to your country of origin or where the asset is cited, so where's the asset located, obviously they get first bite of that cherry, so they get first taxing rights. So you want to make sure that your structure allows that the tax that you paid in that foreign jurisdiction is used as a foreign tax credit to offset the tax due to the United States. And in many circumstances, especially with those transactions that take place in uber high tax jurisdictions like in Europe, there's no tax due to the US. There's no tax. So you reported the transaction, it's not taxable. But you just want to make sure that your affairs are structured in such a way that that foreign tax credit does work to your advantage. That's number 4. Number 5 would be around qualified dividends. This is a bit contentious. So jurisdictions where there's a double tax treaty in play with the United States, one of the typical clauses around dividends provides that dividends paid out from the other country will be taxed in the same preferred manner as dividends from a U.S. company, so the qualified dividend tax rate. And that can be quite material. So like if you get dividends from a company in Singapore, there's no double tax treaty with the U.S. So it can be taxed depending on what your marginal tax rate will be. It's up to 37%, right? Plus state tax if you're in California, already way over 50%, depending on your situation, right? So it's a material amount. Now, if it is that you were receiving dividends from a jurisdiction with a double tax treaty, for example, Indonesia or Australia, it could be taxed at qualified dividend tax rates, which would be 15 or 20%, depending on your situation. So basically, it could be half, depending on what you're doing. So there's a built-in incentive to create structures which utilize or leverage these lower tax jurisdictions if you have the ability to structure before you enter the US. Now, obviously, there are treaty abuse clauses, there are limitation of benefit clauses, there are, rules around economic substance. So it's not just, I hear people talking, I always get these conversations. Well, I'm just going to set up a company in Malta or maybe some country. I'm just going to pass the dividends through. No, it doesn't work like that. There are certain rules that are in play that foresee what are considered to be abuse of the tax treaty. So you want to have a conversation with your preferred tax advisor to make sure you're doing things the right way. But number 5 would be utilizing the tax treaty and to enjoy, for example, qualified dividends. That's 5. And number 6, last but not least, and this is the first thing when we're doing immigration tax consult, the first thing everybody asks about is a trust, because they watch some movie, they watch their favorite television series, and somehow a trust has come up like this magical box that makes everything right. It's like this panacea, like this silver bullet. It is not. It is not. So yes, it could be to your advantage to set up a trust before entering the US, but this is really around asset protection. This is really around probate avoidance. This is really around creating an estate tax blocker. This is not about income tax. It's typically not about income tax planning. Typically speaking, there's no income tax advantage to setting up a treaty as you are a U.S. person, and so you're the grantor or you're potentially the beneficiary. So it's about other advantages, which are super important, but not typically around income tax. So those are the 6 of the strategies that we could have a conversation with someone. We can use in having a conversation with someone who is considering that big step as they move to that land of opportunity, the land of the free and the home of the brave. My name is Darren Joseph, Tax. Have a look on our website. We have over 2,000 articles on cross-border tax. We have over 1,000 videos on YouTube and podcasting platforms.
So if you're a 6, 7, or 8-figure investor, entrepreneur, or business owner who needs a tailor-made solution from a qualified team of professionals, we can help you achieve the international lifestyle, the freedom, and even the tax savings you're looking for. Visit us at htj.tax and live that international life.